Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Excited for today's show. We've got Paul Moore from Wellings Capital on the line with us, and this is his third appearance on the show. Brings a lot of value, lots of experience. And one thing he just said that lots of experience has come from lots of failures, which is
Yes.
awesome. But Paul, thanks for being on the podcast again.
Brian, it's such an honor to be here, but why would you want a guy who had a podcast called How to Lose Money?
That was actually a really good podcast. And I'll be honest, I was a little bit upset when you guys stopped doing it. It was you and Josh Thomas, if I
Yeah,
remember right.
right. Yes,
Yeah.
that's good memory.
Yeah, but I thought it was a great podcast. You guys had your flag structure, but how to lose money, it's just kind of like the opposite of what you expect on a podcast. But you look at the warning signs, the red flag moment, and the point of no return, and it really helps you as an entrepreneur to learn from other people's mistakes. So
Yeah,
yeah,
it
that's
really
it.
does. And you know what I didn't know in 4 years of doing that show,
Mhm.
Brian, the most brilliant investor in the world, according to Bill Gates and
Mhm.
Warren Buffett, was Charlie Munger. God rest
Mhm.
his soul.
Yep.
Charlie was obsessed with one thing. Was
Mhm.
it brilliant algorithms he could create? Because he surely could have. It
Mhm.
was it some brilliant new concept of investing. He surely could have brought that to the table. No, it was one thing, and that was avoiding mistakes. He
Yeah.
said if you can avoid mistakes, you can do really, really well in your investing. And that doesn't sound like the most brilliant investor in the world, but did you know that if Berkshire Hathaway,
Mhm.
Buffett and Munger's company, if they lost 99% of their
Yeah.
value right now, that means if it was $100 a share, it would go down to $1 a share. It would
Mhm.
still wallop the S&P 500 for the last 60 years.
Yeah.
That's a track record we should pay attention to.
Yeah. In Warren Buffett's tribute to Charlie after Charlie's death, he also pointed out their philosophy was to buy good companies at fair prices.
Yeah,
And I think that really translates to real estate because a lot of people, are looking for the screaming good deals.
yeah.
How do they make Berkshire Cat? I mean, avoiding mistakes, but they're paying market prices for good assets. And I think, yeah, you put that together, and there's a lot of goodness, a lot of things that translate to multifamily there.
Yeah, they're looking for recession-resistant
Hmm.
companies with a great durable product
Hmm.
run by fantastic management teams. And that's what my company looks for when we're
Yeah.
investing in real estate as well. We're looking for, recession resistant assets, and multifamily would prove to be a big one,
Hmm.
run by great teams. And of course, multifamily, a durable asset. What would that look like in multifamily? Let's think about it. It would be almost any multifamily now. If you look at the statistics in
Yeah.
the next 10 years of the shortfall of multifamily in America. Of course, you could buy or build in a bad location where everybody's
Yep.
leaving, but you should try to avoid that, of course.
Yeah, and I've thought about it a lot. I mean, if you use history as a guide, a good friend of mine, Bruce Frazier's the guy's name. You probably know him,
I
but
know Bruce really well.
so he got on a stage at a conference 2 years ago, and he said, if I could go back to August of 2007, that's where the market peaked, real estate market peaked.
Yeah,
He said, I would buy everything I could get my hands on.
yeah,
And he was talking, I mean, because this was 2 years ago, right about the time that we peaked with
yeah,
multi. Actually, we were already on a downward slide at that point.
right.
But the point is he was still buying because he's following that philosophy. He's like, yeah, we're
Yeah.
buying things that are going to be, solid assets. But I think right now we have an especially good time to buy because in most places prices had bottomed out.
Yeah, it's true. I mean, of course, we can't ever know the bottom except in a
Mhm.
rear view mirror, but
Yep.
it sure appears, Brian, like this would be a fabulous time to buy.
Hmm.
As long as you don't roll the dice and turn it into a risky speculation. Multifamily should be I mean, my book in 2016, a long time ago, called it the perfect investment. And I still believe that, but it can be ruined
Yeah.
by turning it into a perfect speculation, by
Hmm.
using risky floating rate debt, by assuming rents will grow to the sky, by
Hmm.
paying 30% or more over market price just
Yeah.
to get a deal because you've got investor money in your hand.
Hmm.
Those are huge potential mistakes.
Yeah. How do we avoid those mistakes?
I think for me, it's becoming a boring
Hmm.
syndicator.
Yeah.
I sold my company in 1997 and I tried to get the same thrill out of being an investor
Hmm.
or ultimately later a syndicator that I did out of being a startup entrepreneur. Being a
Hmm.
startup entrepreneur has a lot of excitement with it. Also, it
Yeah.
includes a lot of 80 to 100-hour weeks, a lot of pain, a lot of potential failure. And when you succeed, it's sort of addictive. At
Hmm.
least it was for me. And I tried to invest that way. I wanted to get a thrill out of the chase. I was willing to stay in startup mode. I was willing to
Hmm.
repeat the learning curve over and over. I was willing to invest in things I didn't know anything about,
Hmm.
hoping that it would go like my entrepreneurial venture did. And honestly, I turned into a speculator rather than
Hmm.
an investor. And I don't have an answer for how to fix that because everybody's going to be different, but I can tell you those are some things to avoid.
Looking once again, back to Warren Buffett's philosophy. I mean, he says for the average person, the best thing to invest in is the S&P 500.
Yeah,
You know,
right,
that's about as boring as it gets. It's just you set it up once, and then maybe once a year you look at your income and you add a little bit more to your monthly, whatever goes out every month. But
right.
yeah.
Another quote I didn't know when I did
Hmm.
my podcast
Hmm.
was Charlie Munger said, the average person shouldn't expect to have any advantage in
Hmm.
picking stocks. And I would say the average full-time IT person, doctor, dentist shouldn't expect to have any advantage in picking real
Yeah.
estate. That's how I'd say it parallel. He goes on to say, though, he says, we don't design our own engines or build our own egg beaters, do we?
Hmm.
And it's the same thing. Most full-time professionals should stay in their lane and trust a great multifamily syndicator
Yeah.
to do the heavy lifting. And that's what a lot of people, a ton of people I've met have tried to be like a full-time dentist, doctor, attorney, or whatever, and do some syndications on the side. And Brian, you know what?
Yeah.
I don't want to insult your audience. Some people have succeeded at that, but I've talked
Mhm.
to a lot who have really made some big mistakes with
Yeah.
that.
Yeah, and even when I started, everybody has to start somewhere, right?
Right.
And I'll tell you what, me as a first-time syndicator, I made a ton of mistakes. I didn't come from a
Me
real estate
too.
background. Yeah, but it's where do you park your money with professionals, with people who know
Right.
what they're doing. And speaking of kind of riskier investments in Salt Lake, where I'm at, there's a lot of venture capital funds. There's a lot of these startup companies, and it's kind of like this startup ecosystem around here. But I want to invest in some of that, and it is a little bit speculative. And I started thinking, I have no idea how to pick a startup. But turns out there's a lot of people just like me in that industry who have a lot of experience and have funds that pick companies for me. And so it's the same thing. I don't
Yeah.
have to be able to vet any one of those brand new companies to invest in. I pick a fund where the people that they have that capability, and that's where I
Yeah.
invest. So yeah.
Right. I love that. And I think one of the benefits of funds is, it gives you that diversification because
Mhm.
nobody, boring investors might be wrong. They
Mhm.
might pick the wrong asset, and it may not even be anybody's fault. It could be from a weather event,
Yeah.
or it could be because an insurance company fails the day of the weather event. Stuff outside of
Mhm.
boring investors, boring syndicators know what they can control and what they can't. And that makes me think I want to diversify. Now, Buffett
Mhm.
said diversification is for people who don't really know what they're doing. And that really upset me because I thought, I agree with everything else he said, but then I dove deeper and figured out what he meant.
Yeah.
Here's an example. They own Dairy Queen.
Mhm.
So Berkshire Hathaway, if Dairy Queen decided, hey, we want to make a higher profit margin, we're going to invest in the company that makes the cardboard that they make the cartons out of. And we're going to
Mhm.
invest in the printing ink. And we're going to invest in the forests, millions of acres of forest that, to cut down trees to get
Mhm.
pulpwood to make, the paper around the cones.
Mhm.
That's, in my mind, that's dumb diversification because that's
Mhm.
not their sweet spot.
Yeah.
They should outsource all that stuff. And it turns out that's exactly what Buffett does. Berkshire Hathaway has 28 employees and they're
Hmm.
Fortune 7, last I checked, seventh largest public company in America. So they
Wow.
diversify like crazy. They have 108
Hmm.
different companies in 108 different industries, last I checked.
Hmm.
And so I think that's really good for a lot of passive investors. Diversify out to people who are laser focused in their own thing. And now, if you're a
Yeah.
syndicator, I recommend laser focusing on being a great syndicator and not seven other things.
Yeah, I agree. And something that I've seen a lot in the last couple of years, and it's mainly when multifamily kind of went into a tailspin with the rate hikes. And this goes back to another one of the quotes from Warren Buffett: "When the tide goes out, you see who's swimming naked."
Right.
You saw a lot of people jump ship. And I started thinking about this, with some of the peers that I went through my coaching program with. I went through coaching in 2018, but in the last 6 years, they've gone from multifamily to self-storage to single net, retail and things like that. And when it comes to my investment dollars, I don't want somebody who's focused on the same thing long term and not jumping to whatever the latest and greatest is. That's just me though.
I agree. I sat with two investors last week, Brian,
Mhm.
who, were so upset. One of them said, I don't know if I can trust anybody again in the investment realm. Maybe I
Mhm.
should just invest in the stock market. But both of them had invested with syndicators who were
Mhm.
seemingly pretty good, but they had diversified and diversified within their company. Remember Dairy Queen?
Yep.
And they got into, and everybody knows this, I might as well mention it, they got into ATMs.
Mhm.
And both
Yeah.
of them lost all their money, and a lot of us know what happened there. And
Yep.
the truth is, if the people who would have represented that had dove really deep, they
Mhm.
might not have invested, represented those investments. And if those investors would have dug really deep, they may not have invested. And my
Yep.
proof for that is I know some people who dug deep years ago and said, no
Mhm.
way, there's too many red flags.
Yeah. I know a lot of people that lost money on that venture, and one of them was actually looking for it invested in that ATM fund 100% because of the depreciation. She was looking at a deal that I had at the time, and she needed a certain amount of
Yep.
depreciation according to her CPA, and that one had depreciation. And I talked with her recently, and yeah, she lost everything on that deal, and the deal she would have invested with me is it didn't advertise the same level of returns,
Right.
and it didn't
Right.
give her as much depreciation. But guess what? We still own it, and it's still cash flowing.
Brian, that is a great way of looking at this because our company had the same situation, and we have so those two guys had invested with us and in ATMs, and both of them
Mhm.
were so regretful. And
Yeah.
there's hundreds more like that out there. Whether, I mean, I don't know, maybe thousands out there that should have invested differently. And of course, again, they couldn't control
Mhm.
that. They didn't know what would happen. But this is another point here. Boring
Yeah.
investors, boring syndicators do deep dive due diligence.
Mhm.
And not to say that that would have absolutely worked out, but for the people who, mortgaged their house and
Yeah.
sold everything they could to invest more in ATMs, again, anybody could have done it, but I'd recommend that people just really diversify and not take a hugely deep plunge on one thing.
Yeah. And here's something I would say to the aspiring syndicators out here. If somebody tells you they're mortgaging their house or using a HELOC or
Yep.
investing using debt, you should probably tell them to think twice about that. But
Yep. Yep.
if I know somebody's using debt to put money into the deals, I have a conversation with them just to make sure they understand what the potential is. But anyway, just
Yes.
throwing that out to the listeners.
Yes, that's a really good point, and I've heard people say stuff like that too. And that's what people do with exciting investments. That's what
Mm.
exciting speculators get,
Yeah.
and or exciting syndicators. And I try to, and I know you and I agree on this, Brian.
Mhm.
I try not to make it sound that good, like you're going to double your money in 3 years. Well, that's possible, but it's
Yeah.
also likely those deals, when the tide went out, like you said, Buffett's tide went out. A lot of those deals that were doubling their money in 3 years, some of them ended up losing all their money. And I'm not saying that's true across the board, but it
Mhm.
sure did happen from what I've heard.
Yeah, I lost 100,000 in an investment last year. It wasn't a double your money in 3 years.
Yeah,
It was a standard kind of like double your money in 5 years is what you usually see in multifamily, but it does happen. I look back at that one, and I mean, a question. I have a good friend that he told me once. He's like, I understand market risk. If I lose money because the market turns south, I get that. That's a risk that I understand. That's a risk I'm willing to take. But, where he drew his line, he's like, what I don't like is the risk from the operators. Operators who are, doing things wrong, who aren't, transparent, who are, potentially, doing things not in an ethical manner. But, and it just kind of brought the point up to me. I mean, like you said earlier, there's lots of things that we can't control in this
right,
business, but there's ways to mitigate a lot of that
right.
stuff. And I think that's where you're going with your boring investor is
Yeah,
mitigate
I
stuff.
mean, just as a quick example, we looked
Mhm.
at 740. So for your
Mhm.
listeners, we're not a syndicator. We're a fund that invests in the best syndicators we can find. We looked at 745 operators and deals
Mhm.
last year, and we only invested in five. So that's 0.66%. And in a sense, that's kind of boring because
Mhm.
we had to have three highly paid people to sift through all those deals. And we said no at the finish line many, many times once we
Mhm.
had already wired the money and we found out something terrible and we literally told the title company, hold on, we're not closing.
Mhm.
So it would
Yeah.
have been a lot easier to close, I tell you, after
Mhm.
months of working on that deal, but I'm glad we
Yeah.
didn't.
Yeah. We had a closing recently where we had a snag. And, one thing that we had as a conversation point with the general partners, of course, nobody wants to lose money, but the conversation we had as general partners was, is this still good? Is this still a good deal? Is this something that's worth backing out of now, losing a couple 100,000? I mean, it's a small deal, so we only had a
Yeah.
couple 100,000 out. And in this case, everybody said, I think the deal is still viable. I think it's still worth going forward on. But yeah, that's something that as a syndicator, you got to be willing to walk away and you got to be willing to lose money. And if you're not, you're going to eventually lose more money than you would by not walking away.
Yep.
That's a tough decision
Absolutely.
to make, though. That's a tough spot to be in.
It really is. And especially if you've already got investors' money wired in and they're all
Mhm.
excited and they're texting you, did it close yet? But
Yeah.
I like to say boring syndicators, boring investors trade
Mhm.
FOMO for FOMO. What I
Mhm.
mean by that is they trade the fear of missing out for the fear of messing up.
Mhm.
And if you do that long enough, you actually get JOMO. I made
Mhm.
that up. But
Yeah.
JOMO is the joy of missing out. That's when you say,
Mhm.
like, I wrote a blog post last Thursday about a deal we missed out on. But I
Mhm.
actually said, you know what? When we looked at this, the fundamentals were kind of murky and we decided to pass on it. And you know what? As much as I hate we missed that huge
Mhm.
upside, if we keep doing this right over and over and over, we'll get enough upside to make us
Mhm.
happy. And the worst thing, Brian, I don't know why this didn't dawn on me before. I was sitting in a cabin in Canada listening to an audiobook.
Mhm.
We were fishing a couple summers ago, and the guy was talking about the fact that if you gain 50% on your investments, that's great. If
Mhm.
you lose 50%, that sounds similarly bad, but it's not. It's much, much worse than the
Yeah.
gain is good. And here's why. If you lose 50%, you've got to double your money just to get
Mhm.
back to square one. And to double your money, you start thinking, oh, I've already lost 2 years. I've got to hurry and double it. And then you start taking a little risk
More
that maybe
risks.
you shouldn't. And then
Mhm.
you may not, but you could start a deadly spiral where you lose all of it instead of just
Yeah.
50%.
Yeah.
And so, a perfect example,
Mhm.
Jeff Bezos of Amazon, obviously said to Buffett, he said, hey, I've been studying what you do. It's not
Mhm.
that complicated. Why doesn't everybody just imitate you? And Buffett
Mhm.
said something like, no, no, nobody wants to get rich slowly.
Yeah. And the reality is, that's how most rich people have gotten rich. I mean, you
Right,
have a couple of overnight successes,
right.
but I mean, you look at even Elon Musk, who Tesla stock tanked in the last couple of days. So I don't know if he's still the wealthiest person in the world, but
Yeah.
you look at him and it may look like he had this meteoric rise, but I mean,
Hmm.
he started his first company in the 90s, you know.
Yeah,
And then PayPal came around, I think early 2000s, and
right.
then I mean, so it wasn't an overnight success in his case either. It was, several, 30 years of really, really hustling and risking to get there. But yeah, nobody, well, not nobody, but yeah,
Right.
getting rich. I like how you said that. When you're trying to get really, really high returns, you tend to go for high risk. And when you go for high risk, that's where people tend to lose a lot more than they bargain for.
Yeah, you ought to listen to Elon's first interview with the Babylon Bee, where he said, hey, people forget that and I don't remember the number, but I think he said the 6 million billion or whatever it was, I
Hmm.
should know, that I made from PayPal. I lost all of it at one point with
Hmm.
Tesla. I had Tesla and SpaceX were just about to shut their doors. And so I think an important thing about what you just said, though, Brian, is, who knows who Jesse Livermore is? Well, I didn't until I looked into this. But 95 years ago, if we'd have been on this podcast, we would have known who he was because Jesse Livermore shorted the stock market in
Hmm.
October of 1929. And
Hmm.
he made $100 million, which I believe, if I'm not mistaken, is about 4 billion today.
Yeah.
Now, it would be easy for you and I to say, hey, let's go be day traders and short the stock market like
Yeah.
Jesse. Well, lots and lots and lots of people, including 5 people I know, tried that,
Hmm.
day trading that is, on the side, and every one of them lost all the money they put into it, as far
Hmm.
as I know. Look, Jesse Livermore couldn't even replicate his own one-off
Yeah.
success. Sadly, 11 years after that incident, he took his own life because he couldn't even replicate it.
Hmm.
Boring syndicators don't imitate outliers, they imitate long-term
Yeah.
basic patterns.
Yeah. Yeah. And I mean, when you talk about that, I mean, the first thing that came to mind was George Soros did that. But, how often do you hear about that? I mean,
Right.
Livermore in 1920, George Soros in 90 something. Has it happened since? I mean,
Yeah.
yeah.
I mean, sure, I'm sure it has, but the point
Yeah.
is, those are not the people to imitate. If
No.
you're a basketball player, I hope I don't offend anybody. If you're 5'3" and you want to go be an NBA star, you can find somebody to imitate. What
Hmm.
was his name? Muggsy Bogues.
Muggsy Bogues. Yeah.
Now, but the fact that there was only one out of the thousands and thousands and thousands of players who have played the NBA, that
Hmm.
makes me think that's probably not the best thing to do.
Hmm. Yeah. Yeah. Absolutely. Absolutely. Yeah. So don't imitate the outliers. What's
Don't imitate outliers, imitate long-term patterns.
the long-term patterns? Love that. Love that. So yeah. So in multifamily, I mean, how do you look at properties now with that philosophy? I mean, what are you looking for and what are you avoiding?
Yeah, we look for all kinds of different things. I mean, we really love value add. You might think by what I'm saying that, we just invest in core assets. That's not the
Mhm.
case at all. We look for teams of operators who have an inside track. And usually
Mhm.
they create the inside track, by the way, to getting deals that many people miss. So we're closing on a deal today. We've
Mhm.
been working on it since, I don't know, 4 months. It's a $51 million acquisition
Mhm.
of a multifamily deal. We're bringing 15 million in the middle of the capital stack. It's preferred
Mhm.
equity. So we're not in first risk position, but the operator was somehow positioned to buy this property that was already appraised at like 65 million. They bought
Mhm.
it for 51. And they
Wow.
had positioned themselves somehow to be able to get this property that a lot of other people would have probably loved to have.
Mhm.
And so they created, what is that, $14 million in
Yeah.
cushion right on day one just by buying it right.
Nice. Nice. Now, are you willing to share how they were able to get that?
I will share it, but this
Yeah.
sounds more like a one-off to me, Brian. So maybe
Yeah.
I'm ignoring my own advice here, but they actually got this from a large REIT
Hmm.
they had closed down the REIT. They had, and in 2024, early 24, I think, they had sold all the assets off and this one remained. And
Hmm.
then a buyer, possibly two different buyers, fell through. So
Hmm.
they lowered the price from what I've been told, and they needed to find somebody who had a 100% track record on closing
Yeah.
Fannie Mae assumptions. And this was a Fannie
Mm.
Mae assumption of 30 million. And they found this group and they said, look, we need a 100% ish guarantee
Mm.
that you'll close. Now,
Yeah.
before I finish, I want to say that's not the norm. The norm in our world is buying from mom and pops.
Yeah.
And so we invest in a whole lot of deals where
Yeah.
a mom and pop had completely butchered it and it was sold at a deep discount just to save it from the bank.
Yeah. I love mom and pops. I bought we bought a property a year ago from a mom and pop, and this is a patience play, sticking to your
Yeah,
price. And the first time it came around, I think we offered like a 5.2 million. It's a small property, and somebody else picked it up under contract for just over 6 million. So they're like $1 million above our price.
yeah,
And then that buyer fell through, and another buyer came in and they offered mid fives, and we were still in the game and we were still at like low fives on our number.
yeah,
And the second buyer, couldn't purchase the property. And then, I get a call from the broker one day saying, "Hey, we've had two buyers that have had this under contract and none of them have closed. Price today is at 4.8. Do you want it?" And I
yeah,
sent an offer in that day. It was like
yeah,
at 4.8, yes, I'll get you an offer in 20 minutes.
yeah.
So there are ways, and I think part of it's patience, part of it's follow up. But
Hmm.
one thing that you mentioned is the reputation of closing a lot of
Yeah,
times will get you the deals.
right.
So if you can close on every deal every time, a lot of times that wins over purchase price, especially for sellers that have strong motivation to sell.
Yeah. Absolutely. And
So
a lot of these sellers, have made a massive profit if they've held
mhm,
it, especially since, let's say, the early 2000s.
yeah.
Some of these have built these properties. I'm thinking of a self-storage property
Hmm.
and that was built in literally 1980, I
Hmm.
think. And our operating partner bought it in 2023. And, it was full of homeless people. It wasn't advertised.
Hmm.
It was, in a great location, but it was all run down because the operator had just kind of lost interest. They
Yeah.
were making money hand over fist, even run poorly. And
Yeah.
so by turning that around and making it run well, I mean, you can imagine that they could potentially double the net operating income in a couple of years and potentially 4x the equity in a couple of years. That sounds like I'm rolling the dice or speculating, but it's not in that case
Hmm.
because it was bought so well from a
Yeah.
poorly run, from an operator who made a lot of profit over a lot of years.
Yeah. The property that I was referring to, the owner self-managed.
Yeah,
And when owners self-manage, I mean, a lot of times they do the lazy thing. It's like, okay, they're still making money, and every single unit was probably about $200 under market because that's how he operated.
hmm,
When there was a vacancy, he wanted to fill it fast. He didn't want to do a lot of work. And the best way to fill something fast is just to, offer it at really cheap prices. And so,
yeah,
yeah, it's the same thing on this one. A lot of our value add is just waiting for these leases to expire
right,
and bringing them up to market rates. And
right,
yeah, I love mom and pops. I wish I could get everything from mom and pops, but
yes,
every once in a while, one of those little gems comes across our desk, and you gotta jump when you get them.
yeah, right,
So
absolutely.
awesome, awesome. Well, let's see. We're about time to start wrapping up. So typically ask a couple questions at the end for everybody, and I guess ask the same questions for you. So first one is, what's next for you?
Yeah, we were frustrated over the last 3 years. We had a growth and income fund, and some of
Mhm.
the deals on the extreme growth side had
Mhm.
no income for a couple of years, so we passed on
Mhm.
them, even if
Okay.
they were solid operators. And then some of them had great income, but very little growth, if any, and we
Mhm.
passed on those. And
Mhm.
both of them would have fit really well into an income fund or a growth fund.
Mhm.
So what's next for us is we're launching a separate income fund and growth fund. The income
Okay.
fund's going to be evergreen. The growth fund will be closed end ended
Okay.
like everything else we've done.
Okay. Awesome. Awesome. And so when you talk about income fund, are you doing mostly preferred equity or what type of assets are you looking for that one?
Yeah, we're always looking to do preferred equity if we
Mhm.
can. There's one type of preferred equity, which is more like mezzanine debt, and it has
Mhm.
a fixed upside. In other words, if it's 16%, we can't ever
Mhm.
get more than that.
Mhm.
We've come up with a new type of preferred equity that has the benefits of common equity, so it has a
Mhm.
lot more upside, but it also has downside protection. And that's the type of preferred equity we're trying to do now.
Nice, nice, nice. Yeah, and if you can get deals like that, I mean, protect your downside, get a little bit more upside. I think that's a home run. Especially, with preferred equity, you're a little lower in the capital stack. Well, that gives you
Yeah,
your downside protection most of the time.
right,
But
right.
awesome. All right. So, if you were to give advice to somebody who's just starting out, what would that be?
I would recommend, and I think you can tell from what
Mhm.
I've already said today, that they go and read almost everything Warren Buffett wrote. You don't have to read all his annual reports, but you can read summaries of those. There's a book called Snowball. There's another one, The Warren Buffett Way. There's The
Mhm.
University of Berkshire Hathaway. There's so many good books. And
Yeah.
just really think through those concepts and think, how could I apply this to real estate investing?
Mhm. Yeah, I love Warren Buffett, and I'm glad you're a big Warren Buffett fan too. But a lot of what I'm doing now comes from something very similar. It's kind of that buy real estate and wait philosophy. That's what he does with businesses. He
Yeah.
kind of buys businesses and waits. All right, last
Can I
question.
make a comment on
Go
that?
ahead. Yeah, absolutely.
Buffett said the stock market
Hmm.
is a vehicle that transfers wealth from the
Hmm.
impatient to the patient. And I
Mm.
think that's true in
Yes.
real estate as well. Munger said the big money is not in the buying and selling, but in the waiting.
Hmm. Yeah, that is true. And that goes back to what we were saying earlier. If I could go back to August 2007, I'd buy everything I could get my hands on because
Yeah,
even though it was at the peak of that market cycle,
yeah,
right now, prices are probably triple. You wait long enough, you're going to make a lot
I
of money in
know.
this game.
I know.
All right.
Absolutely.
Now, last question. How can listeners learn more about you?
They can get hold of us at our website, Wellings,
Hmm.
Wellings. That's
Hmm.
wellingscapital.com/resources, and that'll get them some free special reports,
Okay.
access to my book on multifamily investing, and a lot more.
Awesome. And we'll put that in the show notes for everybody, so you guys can look that up and connect with Paul and offline. So, all right. Thanks very much for coming on the show again, and look forward to having you on again in, yeah, maybe another year or so. Be
All
be four
right.
times soon. So,
All right. Thanks, Brian. It's been an honor.